I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello, and welcome to the Chart of the Week video. First off, I wanted to come clean on a goof that I made in last week's video, in which I tried to illustrate a point with a hypothetical calculation. I said that if the median income in San Francisco were $100,000, that the median or average home price would be $100,000. Clearly, the factor was 8. The home price should have been $800,000, but for some reason I said $100,000. You know, my mother did say, Anthony, someday even you will make a mistake. So I guess I have to live with it. All right, let's move on to some recent developments on the monetary policy front. As you may know, the Federal Reserve has two explicit mandates: price stability and full employment. Essentially, inflation and jobs. And it can be a balancing act at times, like now, when inflation is running a little hot, but the unemployment rate is not quite low enough to satisfy some of our central bankers. And the chief central banker, Jerome Powell, has downplayed inflation, the inflation that we're all seeing, as being transitory. And that has allowed him, or afforded him, the flexibility, at least in his eyes, to keep his foot on the gas pedal. But we got some promising news last week in the form of fairly solid indications that the Fed will begin slowing, or rather tapering, its purchases on a monthly basis of Treasuries and mortgage-backed securities. And that could happen as early as November. Now these, as you recall, these purchases are made from newly created money, and that's something that we have euphemistically called quantitative easing. This is big. It's long overdue, if you ask me, but it is big. It needs to happen, and then once the Fed is done purchasing Treasuries and mortgage-backed securities, and that's expected to be mid next year, based upon the guidance we have received so far. Then and only then will they start to consider raising interest rates. And in this case, it is the Fed funds rate. It's the overnight rate, which is effectively zero. So if you think about other rates, if you think about longer-term Treasury yields, those rates or yields are more market-driven. The Fed can control the overnight rate. All right, so these headlines that we're seeing in the past week about interest rates skyrocketing, we're going to take a look at what the reality is. It's true that inflation and a hint of tightening at the Fed has led to an increase in interest rates, but let's provide a little bit of context here. So the chart that you're looking at is the yield on the 10-year Treasury. And last week, if you can see my cursor, it was at 1.3%. It shot all the way to 1.54%. 1.5% for 10 years. So imagine locking your money up at a rate of 1.5% annually for 10 years. There's not a lot we can say about investment outlooks or anything forward-looking with any great deal of certainty, but I think there's a very, very high likelihood that if you're earning 1.5%, you are not going to outpace inflation, and so that means that your purchasing power will be impaired over that holding period. So let's say you're willing to take a little bit of credit risk. Not a lot, but you look at high-quality U.S. corporate bonds. Surely there's more yield there. So let's take a look at an index of U.S. investment grade corporate bonds. And as you think about the duration or the time to maturity on this basket of bonds, it's 10 years, give or take. So you can compare it to the 10-year Treasury for our purposes. So you're locking up your money for a while is what the point is. So last week, that yield on that index was 1.98, and now it's 2.13%. 2.13% is a tough sell. So if the question came up in the last week or so, hey, are bonds back? Are they back in vogue? Is it time to consider adding some 5, 10, 20-year bonds to the portfolio? I would say that now is a little bit more attractive than last week, but still from an historical perspective, fixed income valuations are just high, meaning that yields are low. And while I think that, not only think, I'm thrilled that the Fed has indicated a path towards what could be considered a more normal monetary environment. That's good. And we'll see if rates do drift a little bit higher in the coming months, then maybe it's a different conversation. But at this point, it's still tough to really consider loading up on bonds in your portfolios. That's it for now. We'll see you next week. Thanks.